Today's session is basically covering some of the challenges that NPOs face. We're going to be looking at compliance matters. So when I look at compliance, we're going to look at obviously what do you need to be registered for? What are the deadlines that need to be complied with? We're then going to look at some basic accounting principles and transactions that affect nonprofits. So I'm going to cover some of the common sort of transactions that I've identified over the last 7 years where people generally don't know how to account for it or don't know how to record it. We're going to touch on management and donor reporting, statutory and fund audits. What are they? How should you prepare for them? And then we're going to look at risk assessment for NPOs. It is a tool that we have developed specifically for NPOs. We'll just cover that a bit and to see how it can add value to your organization. And then lastly, we will take questions and answers. Just in terms of how we will do the Q&As, if you have a question, you can pop it into the chat. I've got Riza Amra, who's the other partner at Turning Point, and Ridwan Khan, who is also our tax partner at Turning Point. They are online and they will probably respond to your question. But if by the end your questions haven't been responded on, I will then go through them as well. And you're more than welcome to switch on your mic at the end of the presentation to ask your question if you are not afraid of coming online and sharing your thoughts. Some people don't like to do that, so you can use the chat function if you want to. Okay, so before we get into the actual presentation itself, just a little bit about us. So like I said earlier, we specialize in the NPO sector. There are 3 of us or 3 chartered accountants at the practice. We focus only on NPOs itself. Our client base, if you look at it, we have 1 or 2 nonprofits. We've been known for our technical expertise purely because we've been working in the sector and we've built a reputation for us. We have covered some of the services that we do offer in previous webinars that we've rolled out with NASCI, but I will cover a little bit about it later on. Okay, and so let's get into it. So NPO challenges and previously when we've rolled out, okay, so pre-COVID, we used to roll out our own training sessions, and it's very different doing a webinar because I like to walk around and things. But so previously when we did this, whenever I did the NPO challenges, and these are my perceptions of what I think are some of the challenges facing NPOs, I'd often see people like nodding in the room because they'd be like, okay, this is me. And you'd get that nervous laughter because that is applicable to our organization. So I hope when I'm going through some of these challenges today, you're obviously going to be saying to yourself, okay, this is also affecting me. So the first one that we basically categorize our challenges or the common challenges that we think NPOs faces into six areas, right? So the first one is dealing with capacity and skills. And in working with NPOs over the last 7 years, what I've identified is that there's often a lack of staff. One, in terms of a number, so physically there aren't enough people, or 2, we don't have suitably qualified people within the finance department. So from a programs perspective, I don't think NPOs really struggle to find people from a program and operational part. But from a finance perspective, generally that is where we've seen that there's a lack of skills. So that for me is a big one, is that, and often you find, you go to an organization for the first time and you ask them, okay, so, what do you do? How big are your operations and your programs? And then you get to the question about, okay, so how big is the finance team? And then you get told, okay, well, we just have one person, and that person does finance and does payroll and does HR and does all the office admin as well, so it's one person wearing many hats. And often that one person is not necessarily somebody who has a finance background or a finance degree or, a BCom or anything. It's maybe they were the person that had the most amount of experience in accounting, or they knew the most amount about accounting. So they got roped into that position. So that's generally the one issue. The other one is from a compliance perspective. So, with the world we're living in at the moment, there is a lot of compliance obligations. There's so many compliance requirements for businesses and for NPOs in particular, that if you are not aware of what are all the different requirements and what are all the different deadlines, it's very easy to fall into non-compliance. So that is one where we've seen, okay, there's a lack of awareness of what are the various compliance requirements, which is why today we are going to cover compliance. The third one is in terms of policies and processes. So another thing I've often found with NPOs, especially, and this has been especially on like audits when we're doing them, is that you find that, okay, when the organization first started, it was quite small and operations have grown. So programs have grown. The vision of the organization, the funders, or not funders, but the people that started the organization, their vision is now coming to fruit, where they're now growing, they're getting the funding, and their program. So they're able to actually achieve what their vision and their goals are. And so they've got policies and processes in place in terms of how to run their programs and how to do what their core activities are. But the flip side to that is, whilst the organization has grown, the poor finance department has been left behind. So the finance department hasn't grown with the organization. And so you find that often there's this big disconnect, because you'll see, okay, there's lots of processes in place from programs, but from a finance perspective, there aren't many, or it's not adequate enough, given the size of the organization. So there's often that disconnect between the two. Third one, or the fourth one, sorry, is donor reporting and requirements. We found that there's often a lack of understanding of the donor reporting requirements, or the donor requirements. I mean, you guys all will have signed lots of agreements with donors, and you'll see that every donor is different. The agreements tend to be different. The reporting requirements tend to be different. So, I mean, I have one example where we had a client, it was an audit client of ours, where they won this huge, they had submitted a proposal and they got this huge grant. And I think it was like for R1 billion over like 5 years or something. And the contract was quite long and lengthy, obviously, and it was with a foreign donor. And the finance department, for some reason, had never seen the contract. And there were all these reporting requirements in the contract, which the client was not complying with. And in year 3, the funder eventually pulled the funding. So they lost that contract. And it wasn't because there was fraud or mismanagement. It was because they weren't complying with all of the requirements. Like a simple thing like, if the contract says, if you're buying assets with that donor's money, and they want the assets specifically tagged with the donor's logo, which some funders do ask for, some of the bigger ones. I mean, those sort of requirements you have to comply with. So if you're not reading the contract and not understanding what the contract says and what your reporting requirements are, that is a huge challenge for an organization. The next one is obviously, which probably should have been number one, budget and the limited budget and funds. Obviously, all NPOs, if you don't have your own sustainable income stream, then you are reliant on funding from on other parties for funding. So obviously, in that case, you are limited with what you can do. So that is a huge challenge for organizations, is getting funding and budgeting with the funds that you have. Then the last one is lack of NPO experts. So I put this one for last because it's often like a contentious sort of issue where often, we get asked, do we offer services pro bono? And I often always tell our clients that nothing comes for free. And I think Riza, who's on the call, also uses this terminology or this line. at what cost is it for free? It always comes at a cost to you. So the reason we say that is that, often we've been, and especially with clients that have come on to us from previous firms where they were pro bono work. And the one thing they always mentioned is that with the pro bono work, or also with working with organizations who didn't specifically understand the NPO sector, is that one, if it was pro bono work, they were put at the bottom of the pile. And I can tell you, as somebody who's come from a corporate firm, I understand that that is something we did. You always gave preference to the paying client as opposed to the non-paying client. And it was in terms of timing of when you did the audit, or in terms of who you put on the job. It was obviously the person that was available. So there's that issue. But there's the bigger issue in terms of working with people who don't understand the NPO sector. I still recall my very first audit client that we took on. At my clearance meeting with the client, I mean, we had a long management report point, and we had a whole lot of audit adjustments and things that we had identified. But her comment that she made stuck with me, and it was something that I've heard subsequently in other audits. And her comment was that, you understand us. And I was like, but obviously I should understand you, because I'm the auditor, I need to understand your business. And she said, no, but that is something that they struggled with previously with other accountants, in that they didn't understand the NPO space, they didn't understand the challenges and the compliance requirements and the complexities that NPOs face. So that is a challenge for you. Obviously, you need to work you need to partner yourself with people who understand your organization and some of the challenges and the sector in which you operate in. So for me, these are the 6 key sort of challenges that I think NPOs face. I hope, as I've been talking, some of it you are thinking to yourself, yes, I agree with that. Maybe more other challenges that we haven't included in here. But for now, that was my take on some of the challenges. Okay. Then just put the NPO sector into perspective. Sorry, I'm just going to move my screen. If we look at it, this was data that we've obtained from DSD, from Stats SA, and from the SARS website for 18As. I mean, if you look at it, there are 230,000 registered NPOs in the country. That's just registered. I mean, you get a whole lot that are also not registered. So that number is obviously going to be much more. From that 230,000, look at the non-compliance. We are sitting with 58% of your NPOs are not compliant, which is a huge thing. I mean, and we've seen that with, when we take on clients, there's a huge backlog of things that haven't been done because one, the client wasn't aware of it, or two, the client assumed the accountant that they had hired was doing it, but nothing was done. So that non-compliance is a huge issue, and it obviously has a negative implication on the organization. We're going to touch on how it can negatively impact you as we go along today. Then an interesting one is that from the 230,000 registered, SARS has 26,000 18A PBOs. Now that number does sound low in relation to obviously the total number that's being registered, but it could be low obviously for 2 reasons. One is not all organizations would do 18A activities, but I think it's also low because there's often a lack of understanding of what it means to be registered as an 18A organization, what it means to be registered as a PBO, which is why our upcoming sessions that Ridwan Khan is going to be doing is going to touch on those areas. So for today, we're not looking at tax at all, but it's just something to keep in mind. And with 230,000 registered NPOs, it stands to reason that obviously the NPO sector is then the second largest employer. And for me, these stats are huge. I mean, I know back when I was in corporate, if somebody had asked me about an NPO, I would have said, oh, they're people that don't have money. They can't pay fees. And that's often something that people, when we say now, we work with NPOs, the first thing that we get told is, but isn't NPOs don't make money? so how do they pay? How do they pay for services? And then you have to explain to them, but an NPO is a business. The only difference is that obviously you cannot distribute the profits that you're making, but you are running a business essentially, which means you need to have the same processes in place that a profit entity would have. And I think that change in mindset is probably what a lot of people need to get around. So that is just putting the NPO sector into perspective. And then before I touch on compliance, right, I didn't include a slide on this, but I just wanted to maybe cover this before we go into what you need to be doing, like in terms of complying with everything, is just to basically touch on first, what are your registrations that's mandatory and voluntary? So often when we speak to people, especially new clients, we will go through with them, okay, what are the mandatory requirements? What are the voluntary requirements? And I'm always amazed that people don't know what they need to be registered for, what they can be registered for, leave alone what submissions need to be done. So before we get to the submissions, let's just look at what are some of the registrations. So if you are a nonprofit organization, so a nonprofit, right? Your first registration, which is voluntary, is that you can register with the Department of Social Development to get an NPO number. I think most nonprofits generally do that because it sort of legitimizes your organization. So that is a voluntary registration. It is not mandatory for you to register with the Department of Social Development. The other voluntary registrations that you have is to register with SARS as a PBO, so a public benefit organization, so you get tax exemption. And obviously with that 18A if you qualify. And then VAT registration is voluntary, right? We're going to be covering VAT and PBO and 18A in the upcoming webinars in the next 3 sessions, I think. So for now, just be aware that those are voluntary registrations that you can do, and they're important ones. If you're looking at the PBO registration, that means you're tax exempt. If you don't get your PBO exemption status, that means if you do make a profit, which some nonprofits make, you may be subject to income tax on that. So an important one is to register as a PBO. The VAT registration, that is money that you can get back from SARS. If your income is, and I'm just going to touch briefly on it, if your income is grants and donations, that income is not subject to VAT. But if you are paying rent to somebody, for example, who is a VAT vendor, that is money that you can get back from SARS. So it's an important one, voluntary VAT registration. Now let's look at the mandatory registrations that you have, right? The first one is that if you have employees, you have to register with SARS for PAYE. So you register as an employer with SARS, you'll get a PAYE number, and you have to then do your submissions for payroll taxes. You also have to register with the Department of Labor to get a UIF number. So there's often this misconception that if you register with SARS, you don't need to register with the Department of Labor, and that's incorrect. So the UIF number that you get on your SARS EMP 201 is different to the UIF number that you will get from the Department of Labor. So you have to register with SARS and you have to register with the Department of Labor as an employer. Then, because you have employees, you also need to register with the Department of Labor for workman's compensation. That is, and we'll look at the compliance for that. So that's also a registration. Then you have skills development levy. So if your payroll cost is above 500,000, then you have to register for SDL. There are certain exemptions. That is, if your SARS tax exemption letter specifically says that you are exempt from SDL, then you don't have to register for SDL itself. Then we have income tax. So if you are registered as a not-for-profit company, so that's an NPC, where you've registered with CIPC, you are automatically registered for income tax. So you don't have to worry about that. But if your nonprofit structure is in the form of a trust or in the form of a voluntary association, so in that you've got a trust deed or you've got a constitution that is governing your organization, then in your case, you have to register for income tax on your own. It's at the moment, it is not an automatic registration. So you would have to register for income tax. And the reason you need to register for income tax is that if you want to do a PBO application, step one is that you first need to have an income tax number. So that was your mandatory and voluntary registrations. Okay, so I just want to recap. Your mandatory is SARS, PAYE, Department of Labor for UIF, and Department of Labor for Workmen's Compensation, SDL if you're above the threshold, and income tax, right? Your voluntary is your VAT, your NPO, and then the PBO 18A. So we're now going to look at the actual compliance requirements. So some of the compliance requirements that you have are monthly, some are bi-monthly. So if we look at from a SARS perspective, on a monthly basis, you've got your payroll taxes. So your employee taxes that you are deducting from your staff, and you have to submit your EMP 201 to SARS every month. Your submission and the payment must be made by the 7th of the following month. Very important to look at when the 7th falls, because if the 7th is on a weekend, the money needs to have gotten to SARS by that Friday. It must have cleared by the Friday. And then non-compliance will result in a penalty of 10%. And then SARS charges interest on a daily rate. And it's important, it's not just the submission. So you will, if you submit by the 7th, but you pay on the 8th, you'll still get the 10% penalty, and SARS will also charge you interest, because it's the compliance requirement is that you need to submit and pay. So very important to look at that. So that is SARS. Then you have the Department of Labor from a monthly compliance perspective. So yes, you are submitting to SARS your PAYE and your UIF, and you're paying it over to SARS. But Department of Labor has their own portal called U-Filing. It's their own return. So basically, you have to register with the Department of Labor for U-Filing account, and you have to submit a monthly U-Filing return. You submit it by the portal. You don't have to make any payment to the Department of Labor, because you would have paid SARS the UIF. And the reason Department of Labor has come out with this U-Filing, and it's been around for about, I think, 4 years now. The reason they did that is that when you pay SARS, you are paying one amount. So for your organization, you're paying one figure for all your employees. But the Department of Labor doesn't know that who that money relates to. So the U-Filing return is basically where you will add all your employees, and it lists each person. So for every month, you have them there, and it'll show what was their portion of the UIF calculation. Okay, so most people don't do this one. They're not aware of it. So if you are in that boat, make sure that after this, you register or contact us to assist you with registering and getting you up to date with that. Then we have your bi-monthly, or sometimes it might be monthly, VAT submissions. So you've got your VAT return, which basically needs to be submitted and paid by the 25th if you're not using e-filing. So basically it's the last day of the month, right? Otherwise you use the 25th. Now most nonprofits are in a refund position. So you're not going to be subject to penalties and interest, but if you delay your submission, obviously your refund is going to be delayed. We're going to cover later on how to actually track your refunds with SARS from a VAT perspective. So just keep that in mind. Okay, then if we're looking at our annual and biannual compliance, right? So the first one is income tax. And most people or most organizations, when you ask them about income tax, they'll say, you know, I often ask the question, so have you submitted your income tax return to SARS? And the question or the comment that I always get is that, but we tax exempt, so we don't need to submit an income tax return. That is where you are wrong. So that is it's an incorrect statement to make, because whilst you may be exempt from income tax, the submission of the income tax return is an administrative requirement. So if you are tax exempt, you don't complete the normal IT-14, you complete an ITE 12 I-form, which is essentially a 2-page tax return that has to be completed by all organizations. So if you are not a PBO, so that means you haven't applied to SARS for tax exemption, then you've got to submit the normal IT-14, which is your annual income tax return. And your deadline is 12 months after your financial year end. So you must be within the 12 months. So if your year end is the 28th of Feb, you have up until the 28th of Feb of the next year to submit your income tax return. So whether you are a PBO or whether you are not a PBO, you have to submit an income tax return. So that's a common misconception that organizations have, is that they don't need to submit a tax return to SARS. Now, the risk you have is that if you are a PBO and you are not submitting this tax returns to SARS every year, your PBO status will be at risk. If you go back and read your SARS tax exemption letter, you will see there that one of the requirements of maintaining your PBO status is to submit your annual income tax returns to them, right? So very important. Another impact that this can have if you haven't done your income tax returns is that you can't get tax clearance. And if you can't get tax clearance you are applying to, you're registering for a CSD, you won't be able to register for that either because that is linked to the SARS portal. So if you are not tax compliant, you won't be able to do your CSD registration. So very important is to make sure that you are submitting that income tax return annually. Okay, then we have the SARS EMP 501 reconciliation. So every month, you are submitting to SARS the EMP 201, which is basically a 1-page document where you are detailing to SARS your total PAYE, total UIF, total skills development, levy for the month, and you're paying it over by the 7th, right? Now SARS wants you to do a 6-month reconciliation and then a 12-month reconciliation. So the 6-month reconciliation works for the period 1st of March to the 31st of August, and that deadline is always the 31st of October every year. Then your annual EMP 501, which is the one where you are preparing the IRP 5s, runs from March to February, and that deadline is the 31st of May, right, every year. Now, previously, we hadn't seen SARS charging penalties for non-submission or late submission in prior years, but I can tell you this year, for the first time in the last 7 years that I've been doing this, we've seen SARS, one, they are charging penalties for late submission. We had a client which asked us to assist them with their 501 recon, and they came to us after the 31st of May. So it only got submitted in June. SARS has levied them with a 12,000 Rand administrative penalty, even though the 501 reconciled to the 201 and they didn't owe SARS any amount, but because they were late by like 2 weeks, SARS issued them with a 12,000 Rand penalty, which we're currently trying to get waived. So we've submitted an objection for that. So very important is to obviously look at the timelines, make sure that you're complying with it. Okay, so that was SARS EMP 501. Then we have the Department of Social Development. So this is only applicable if your organization is registered with the Department of Social Development as an NPO, which means that you have an NPO certificate and you have an NPO number. So if you are falling into that category, then you have to submit a narrative report and your financial statements within 9 months of your financial year end. Non-submission is considered to be a criminal offense. It can also put your NPO at risk for non-submission. Now, here's a challenge that we've been experiencing with the DST submissions, because as part of our services, we also assist our clients with doing submissions to DSD. The online portal at the moment currently there's an issue with it. If you are trying to request the password, one, it either comes through, but it doesn't work, or two, it says it goes to an email, but nobody actually receives it, or three, it's going to an email, these are the experiences we've had where it's going to an email which nobody even knows who the address belongs to. So I actually managed to get hold of somebody from DSD yesterday, and they are now assisting us because we've got about 5 submissions that we need to get done, and we were unable to do it via the portal. So if you are sitting in that same situation, maybe drop us an email to see how we can assist you on that. So that's your DSD narrative report submissions. Then other compliance that you would need to be to look out for: workman's compensation. So like I said earlier, if you have employees, you have to register with the Department of Labor for workman's compensation. This is an annual return that you submit, and it's due by the 31st of May annually. It's calculated by using your payroll costs, so your estimated payroll costs. And an important thing to note is workman's compensation is an organizational cost. So it's not like employee taxes, where your employee taxes you basically deduct from the employees and you pay it over to SARS, whereas workman's compensation is an organizational cost. So it's something you need to maybe include in your budgets. And often people are not aware of this one, and they've been operating for years and they've never submitted a workman's compensation return. And then they register, and there's penalties for previous years that they need to fork out for. So if you are unsure if you are registered with for workman's compensation, maybe you need to look into that. We've also found, often in organizations where people have come in and, somebody else was there for a number of years, you just tend to do what the person before you was doing. And if they didn't tell you about workman's compensation and you've never heard about it before, then obviously you're not going to know that you need to register for it and you need to submit a return. So, but you don't have that excuse anymore, because after listening in on today, you do know that there's something called workman's comp, and you have until you have to register, do your return, and pay it over by the 31st of May. Another compliance issue is CIPC. This is only applicable for NPCs. So if you are a trust or a voluntary association, this is not applicable to you. If you are registered with CIPC as a not-for-profit company, then you are required to submit an annual return to CIPC, which is due on the registration of your anniversary. Another challenge that we've seen with this is that CIPC usually sends out a reminder to organizations, to say that your return is coming up, but it sends the reminder to the person who registered your company. It depends if you used an accountant to do your company registration, it's probably going to that person. And if they're not sending you that reminder, you're not going to be aware of it. Often you find your company is placed into deregistration, which is the penalty. So what SIPC does. So one is, if you don't submit for, I think, 2 or 3 years, then they place you into an automatic deregistration. And then to get the company reactivated, then you obviously have to do the submissions and pay the fee. There is a penalty for a late submission for your annual return. And there's a calculation that you're doing. So very important, make sure if you are an NPC sitting in on this webinar, go back and check whether you are actually compliant with CIPC or not, whether your organization is showing as active or not. Okay. So that was basically the compliance, all the different dates that you need to comply with. Now, if we look at what is some of the challenges of how to actually, that you have with, complying with everything. So one of the challenges that I've seen is that often organizations cannot, or they don't comply with any of the requirements because, one, their records are not up to date. I mean, we've met so many organizations or so many individuals, and you speak to them and you ask them, okay, so when was the last time you submitted a tax return, or when was the last time you did financial statements, or how often do you update your financial records? And for some of them, you get the good ones where the records are maintained on a monthly basis, or even on a quarterly basis, but you get the ones where there are no accounting records. So if your records are not up to date, then obviously you're not going to be able to comply with monthly requirements or bi-monthly requirements for submissions. The other challenge that organizations have is there's an insufficient funding. So they don't have the money to pay an accountant to get them up to date, or they don't have the money to pay staff the required salary, to attract people into that position, or they don't have the money to actually pay SARS. So often they will do a submission, but they don't have the funds to actually do the payment, which then means they're non-compliant from a payment perspective. The other challenge is generally just being unaware of deadlines or missing deadlines. And then obviously, if you miss the deadlines, then you have a cash flow implication to the organization, because there's often a penalty and interest attached to that. Unaware of the various portals or sites to be used. This is also, a huge thing. You're speaking to people and they don't know that there's things such as a e-filing site, or that you can go onto e-filing or Department of Labor. They don't know that these sites or portals are available to them, because there's just a lack of awareness and a lack of understanding of what can be done. The other thing is sometimes obviously your e-filing login details are not with you. They're with your accountant or your ex-accountant, and that's also a challenge, getting your information across. Then one other thing is obtaining your SARS tax compliance status PIN. There's generally people don't understand how to do that, how to get a tax clearance certificate, how to get your letter of good standing from the Department of Labor. Now, you can only get a letter of good standing if you are registered for workman's compensation and you are up to date with your workman's compensation returns and payments. So that is also a challenge. Submission of the DST narrative report, like I mentioned earlier. Currently, the challenge that's there is that the portal or the online submission is not working properly. So we luckily, we still within the 9 months with the 3 clients that we're doing the submissions for. But one of my audit clients, I was just chatting with him the other day, and he said that they haven't even submitted last year's return as yet, because he is new to the position and the password is going to the old person. And so he's having challenges with that. And whenever he tries calling DSD, he never gets anybody to assist him. So, those are some of the challenges that are out there. In terms of how to manage some of these challenges, from a records perspective, that is something you can actually control by doing timeous processing of your accounting records. Also using automated data capturing and processing. Last week, Lisa did, a very interesting session on some of the tools that's available out there. We're using Xero currently at our practice, and that is something, as an NPO, you need to be making sure that, okay, you're using, the right software, and that's going to give you the information that you need. So that can assist you with your challenges. In terms of, not having sufficient funds, the way you can maybe, control that or look at that challenge is monitoring your funds. This is something that as part of management, you should be monitoring actual versus budget on a monthly basis. And I'm shocked as to how many NPOs out there who don't do that, who don't actually monitor their funds on a monthly basis to see, yes, they track project, but they don't track organizational as an organization as a whole. So that would be one way of controlling the funds issue. In order to maybe be on top of all the deadlines, use project management tools, to manage your things, so that you're not in the position where a deadline has come and gone and you're not even aware of it. So an example, and Riza did go through some last week, we use Asana as our project management tool. So just as that, that would be a means of keeping on top of, the different reporting requirements that you have. Maintaining a database of all your login details. So often we have this issue with clients where we ask them for e-filing login details, right? and they don't know it, and the person has now left the organization and nobody else has it, or ensuring public officer details are are current with SARS. That's another one. I should have put that under challenges, but making sure that that is correct is very important. We've got so many clients where the public officer that's on SARS system hasn't been at the company for or the organization for the last 5 or 10 years, and now we need to remove them and appoint the new person, or you need power of attorney. And it's such a nightmare managing that process. So making sure that, your public officer that you have with SARS is actually the current person, the details are current. So that's an important thing. Then we've got capacity building and training of your staff. So, if with all the challenges that you're experiencing and all the compliance requirements, I mean, anybody in finance will tell you that there's so much that they need to be aware of and so much that they need to be on top of, that as an organization, you need to capacity build. So obviously, sessions like these are excellent for your finance team, for your staff, because you're training them up so that they can then better control or better manage these challenges that they are experiencing. Okay. I'm just going to take a quick sip of water before we go on to our next session. Okay, so if we're now looking at, I mentioned earlier, some of the challenges that, that people have is that they're not even aware of how to get things like a tax clearance certificate, right? So for tax compliance. Now, previously, you used to get an actual tax certificate or tax clearance certificate from SARS. At the moment, or they've changed it now, I think it's for the last 2 years maybe, where you don't get an actual tax clearance certificate, but you get a tax clearance PIN. How do you get this? Well, it's via the e-filing portal. So basically, you would log in to SARS e-filing. You will go to the your tax compliance status tab, which is basically on the left-hand side of your screen. You will then activate the tax compliance within the tax status tab by filling in all the information that they require. And then once you fill the information, you will then view your compliance status within the My Compliance Profile tab. And then you literally just clicking on Generate Request by Tax Compliance Status Request. Now, when you are requesting your SARS tax clearance PIN, if you are not compliant, it will show you everything that you are not compliant on. And this is often when people suddenly, when they want a tax clearance PIN and they ask the accountants or they ask somebody to get it for them. And this is when they now see, oh, okay, we haven't submitted tax returns for the last 5 years, or we owe SARS money for employee taxes because it's interest that, that has accumulated over time. I mean, even if you owe SARS like 20 Rand or something, it will show as non-compliant. So very important to obviously make sure that you are compliant. So, and these certificates are usually valid for 12 months. So when you are running it, you will obviously be able to see, okay, where's your areas of non-compliance? And then you obviously then need to resolve those areas. So if you have outstanding tax returns, that means that you're going to have financial statements that goes with it, because the return has to be submitted and SARS then asks for financial statements. If you've got outstanding monies that's owing to SARS, you would then need to run a statement of account, which is basically my next slide showing you how to obtain a statement of account from SARS. So basically, again, via the e-filing portal, you navigate to the SARS correspondence, which is usually right at the top. And then it will then show you all your different tax types. So the applicable tax types will be reflected within request. So you'll see it'll be request PAYE notice or request VAT notice or request income tax notice. So whichever statement you are looking for, you will select that, and then you will then have to select the year that you want it for. So remember, SARS works on tax years, which is 1st of March to the 28th of Feb. So if you are looking for a statement of account for maybe for December 2020, that would fall under the 2021 tax year for SARS, right? So very important, you put in your tax year and then you then click OK or continue, and then it will provide you with the documents. But I'm just moving the screen, right? Best practice that we've put in is to check your statements of accounts periodically. So especially with like employee taxes, normally SARS does issue every month. They do issue out the notice for the statement of account, but it's good practice, obviously, once you've filed it, maybe just run it and you've done the payment, run the statement of account a few days later just to see that there aren't anything outstanding for that period. Okay. Next up is VAT status and refund dashboard. So earlier I mentioned that for an NPO, VAT registration is voluntary if you don't have like trading income. So because there are certain requirements as to when you need to register for VAT, but for most NPOs that are earning donations or grant income, generally it would be a voluntary registration. But if you are registered for VAT, SARS has a VAT status and refund dashboard. So again, you log into e-filing like normal, and then on the left-hand side of your screen, you'll see an area called VAT maintenance. You just click on that, and then you choose your refund dashboard, which will then populate with the screen that we have up on our slides, basically showing you the different VAT periods, and they have these icons which basically tells you what the status is. So the traffic signal and the colors will depict the status, whether it's under audit, whether it's finalized or not. So it's actually a very nice tool to manage, to monitor your timeless receipts or delays in refunds. And this, I mean, I can tell you, we've got clients where I had one client where they had about 600,000 worth of VAT that was outstanding from SARS for prior periods. And it was because they had been selected for audit and nobody even at the organization knew about it or did anything with it. So we had to assist them to address all the SARS requirements, and eventually they got their money out from SARS. So this is a nice tool, or it's a nice quick way of checking, okay, what is the status of your refund? And an important thing for NPOs or if you register for VAT is to continuously monitor this. You know, this is money that, you know, it's a cash inflow for your organization. So making sure that, okay, if your refund is, you know, hasn't come through as yet, what is the delay? Checking up with SARS, you know, you must be on top of that. You cannot just submit the return and then wait for the money to come eventually. You know, you have to monitor this on a regular basis. Okay, we're now going to move on to the accounting principles and transactions section. So just, this is not going to cover, like, I mean, I'm not going to go into too much detail. We're covering at a high level, you know, just some basic fundamental accounting principles and how you should, as the finance person in your organization, treat and record certain transactions. Okay, so a simple thing is basically what is accounting records, right? So your accounting records is essentially all the documents or the information that you are using to prepare your annual financial statements, okay? Which is a summary of your results for the year. So what goes, or what constitutes as accounting records? Obviously, your trial balance and your general ledger. Your management accounts is also considered to be accounting records, and your supporting documentation and your annual financial statements. Now, all of this information is very important, and how you manage this process and how you collate and store your information. I mean, supporting documentation with COVID and how things have gone in the last, you know, the last, what's it now, year and a half, almost, yeah, year and a half that we've gone into, you know, with lockdown and things, your supporting documentation has never been tested more than this. I think your process is over your supporting documentation. I mean, I can give you examples where we went into lockdown last year in March, well, at the end of March, and I had audits that had to be done where the client was based in Gauteng and we are based in KZN. And obviously now we're sitting in level 5 lockdown, and the audit was supposed to take place in that level 5 period. But we were actually able to do those audits purely because those clients, I was lucky enough, those clients' processes on a monthly basis were excellent. I mean, they, besides maintaining manual files, they maintained an electronic recording system. So every single payment request with the corresponding invoice was filed per month, and that was their normal process that they had adopted. Their accountant that they had was like, she is my post child for any client, I want to talk about. She's the poster child that I say, because she is the one that her records are there. So we don't need to actually even select a sample, because she gives us access to everything, and every supporting document is available. So when we talk about maintaining supporting documentation, I think the last year has taught us that, we need to move away from the traditional thing of printing everything and filing it. You need to look at other means of document storage, because everything is now moving virtual. So your supporting documentation, very important as your accounting records, because you have to be able to support what you are putting in your trial balance. So be it a grant agreement, or be it an invoice, or be it a petty cash request, that's all important. Often we find, when we're doing audits on clients, or when we're engaging with clients, even for accounting work, not everybody has documents, or the common thing I see is that agreements are not signed. So there's a grant agreement, but it's not signed by either party, or it's maybe signed by one party. So all of that would fall under maintaining proper, accurate accounting records and supporting documentation. Obviously, your financial statements is the collation, it's the summary of all of that, right? So everything that goes into the financial statement comes out from your trial balance and the documents that you maintain. And obviously, if you have a proper record maintenance system, getting financial statements is quite easy, because it's just an end product. But most organizations struggle in the sense that their accounting records are a mess, because they're not up to date. They don't have supporting documentation available. And then to get to financial statements then takes a long drawn out period, which then has a knock-on effect, because if you are behind on your financial statements, then you are behind on your submissions with your income tax return to SARS. You're behind on your submissions to DSD, right? So very important is making sure that you're maintaining timeous and accurate accounting records. Just some basic terminology for NPOs, which I think is important to understand and to know the difference between certain things. If we look at income, right? So income can be quite broad, but if we think from an NPO perspective, your revenue, so the amount that you're showing as revenue in your annual financial statements is basically the income earned from your core activities. So if you are only collecting grants and donations, that would fall under income, right? If you do have, as part of your organization, maybe you have a small little charity shop where you're selling certain items, that would form part of revenue, but it would be sales revenue that you have, right? Or if your organization has, maybe you'll do capacity building as well for other organizations. So that is service revenue that you have, right? So very important is that when you are recording your revenue, your accounting system needs to be set up in a way so that it reflects the nature of the income. So if you just put every single amount that comes into the business into a line item called revenue, that doesn't tell the story of your organization, because your organization might have training income, it might have a charity shop income, it might have general donations, it might have grants, right? So your processing should reflect that. So when I say your processing reflects that, it means that when you are doing your monthly processing, you should be doing project reporting or project accounting, where basically the income that comes into your bank account, you then allocate it to a specific activity. So is it a donation? Is it a grant? Is it sales, or is it service, or depending on what your organization does. Then that information also helps you to generate meaningful management reports, which we're going to talk about in a few minutes. Other income that you would usually see, so if we think of financial statements, revenue is usually the first line on your statement of comprehensive income, right? Which is essentially your income statement. So your revenue line item is your core activities. So income from core activities, your non-core activities. So interest income, dividend income, that should not be disclosed as part of revenue. That is other income because that's passive income. It's not your core activity as an organization. Okay, so that's income. If we then look at your expenses, you can split them between direct expenses and core operational expenses, administrative and operating expenses, and as a whole. If you want, I've seen some financial statements that we've done for clients where they want their expenses, to show per program. And again, that comes down to how you are doing your monthly accounting. So making sure upfront when you are starting your processing for the year that your chart of accounts and the way you are processing is actually going to reflect how in your financial statements, and it's going to reflect how you want it in the financial statements. So again, project reporting or program reporting, very important to do upfront. You can't come 12 months down the line after you've allocated everything to income and everything to just normal administrative expenses and then say, okay, but now I want my financial statements to show all the different programs that I've run during the year, or I want my financial statements to show all these different things, right? So it comes to planning upfront as to how you want your accounting records to be captured and prepared. Finance costs, so interest that you pay to the bank or to SARS or on any loans that you may have, that will be classified as finance costs in your financial statements. Okay, your surplus or your deficit is essentially basically after deducting your expenses from your income, it's what is left over. For a company, it's called a profit, and in trusts and your voluntary associations is generally called a surplus or a deficit, and that number flows into your balance sheet as equity. Okay, so that was your income statement, right? If we then look at your balance sheet, which is also called a statement of financial position, if we look at from an asset perspective, it's basically something of value that the entity owns and that you're benefiting from, or it's generating income. It's anything that can be converted into cash, and it can be tangible or intangible. So things like software, computer software, generally that's intangible. Tangible assets normally that most nonprofits would have is computer equipment that you have. If you own property, that would go under tangible. Okay, your liability is basically any debt or obligation that arises during the course of your operations. Most organizations, the liabilities that they have is generally accruals where they owe at year end, they haven't made certain payments. And the other common one, which is deferred revenue, which is, I'm going to touch on that in the next few slides just to explain what that is. And then the last part of our on our balance sheet is just basically our equity, which essentially just represents the difference between our assets and our liabilities. The reason I put this up is that often when you speak to people, at NPOs, they don't understand how to read their financial statements or what it means when they're looking at the balance sheet and the income statement, right? So this was just a quick refresher for those sitting in here who may not have that finance knowledge. Not going to go into much more detail. Okay, so in terms of transactions from an NPO perspective, right? Over the last 7 years working with NPOs, I've come across, that there's often a lack of understanding of how you need to account for different kinds of transactions. So like ad hoc donations that you may get, where, people just put money into your bank account. There's no grant agreement. There's no contract with them. They just donating to your organization. That generally would go as donation income in your financial statement. So when you are capturing that, when the money comes in, you would then allocate that to income, and you can categorize that as donation income. So that's quite simple in terms of how you account for it. Then there's in-kind donations, which a lot of, I know my audit clients, a lot of them tend to struggle with this in the sense, how do we account for it? How do we put a value for it? Should we be recording it in our financial statements? Now, the answer to that is yes, you should be recording it in your financial statements because it is a donation that as an organization you have received from somebody, right? So that's the first step, is that we need to bring it in. The second thing is that at what value do we bring it in, right? Because that's generally where the contention comes in, is how do you determine what the value is? And I always say to clients is that you need to have a process in place as to how you deal with in-kind donations. So one is, if you have a formal policy, so you say, okay, all in-kind donations, you have an in-kind donations register, you must get some sort of confirmation from the donor to say that this is what they are donating, this is the date that they are donating. And if they can put a value to it, that's excellent. So for example, your organization, somebody donated school shoes to your organization. So normally what I would suggest to clients is that you request from the donor in writing to say, okay, we are donating 100 pairs of shoes valued at 50 Rand each to your organization, and this is the date that the donation was given to you. In that case, it's quite easy. You would recognize the donation income, and when you're recognizing it, you should create a ledger account called in-kind donations received. So basically, you would recognize the income, but from an accounting perspective, you now need to have an opposite entry, because accounting is a double entry principle. So we're going to credit in-kind donations received. What do we debit? Well, the debit can either be, is the item still sitting with you at year end, so you haven't donated it to anybody. If you haven't donated it to anybody, then you have to then put it through as inventory, because you still own that asset at year end, okay? And the value you would use would be as per the confirmation that the person has given you. If you have donated that, so the shoes came in and you've then donated those shoes to one of the underprivileged schools in some area, then your journal entry is quite easy, because you're going to credit in-kind donation income received, and then you're going to debit in-kind donations expense, or you can debit project expense, or whatever expense, that where you would put in like donation of shoes and things. So basically you're recording an expense. From a profit perspective, there's no effect in that case, because basically somebody gave you something and then you then gave it away. So you've received a donation and you've donated it on. Where the trick comes, or the tricky part comes in, is if the donor doesn't give you a value for what they're donating to you. So in that case, I always advise our clients is that what you should then do is just do market research to say, okay, if whatever they are donating, see if you can find it online, and then just print that as evidence as to say, okay, this is the value of the donation, and you bring it in at that. Okay, so making sure you bring in your in-kind donations is the first thing. And then maintaining that in-kind donation register. The reason we say maintain a register is so that from a completeness perspective, you don't miss out on any in-kind donations. Because often you might get that a donations come in, but nobody's recorded it anywhere. So from a financial statement perspective, it's going to be missing. Okay, so that's in-kind donations. Then the next one is grants over different financial periods. So, okay, a common thing that we get on when we're doing audit especially is grant income and how to account for it, right? So very often your grant agreements run over different financial periods. So sometimes you get a grant which is for 24 months or 36 months, or even if it's for 12 months, but it's running for a specific period, and the grant agreement specifically mentions what period it covers. And then you also get grants where they have specific milestones or specific project deliverables. Now, how do you account for that grant income in your financial statements? I'll tell you what most organizations do. They just book the income when it comes in. So the money came in on like the 20th of February, and the year end is the 28th of Feb. Money came in for the full grant period, and this grant is over 2 years. So the client has recorded it as revenue. Now, from an accounting perspective, that's actually incorrect, because that entire amount that you've received is not for your financial year, which means then you need to now recognize what we call as deferred revenue, which in simple terms is income received in advance. So you would then basically now to say, okay, how must I work out the advance portion? So if your grant agreement specifically has milestones or project deliverables, then you would use that as your basis. So if you've met a specific deliverable, then you'd look at, okay, what costs have we incurred for that deliverable? And we would recognize the revenue in line with that. Now, for you to recognize that way, you need to obviously have proper project accounting records. You need to be able to say, for this project, these are the costs that I've incurred up to this date, right? Another way of recognizing the revenue is if it's just a 24-month grant agreement with no milestones, no project deliverables, then in those cases, and it's not for a specific program, so it's just a general grant that they're giving you. In those cases, we generally just say, okay, take the total grant amount, divide it by the number of months that it's for, and you work out, okay, how many months have I used in this current year? Okay, so it gets quite tricky. So that is generally that area there, the in-kind and how to work out your deferred revenue is often an area that accountants at nonprofits struggle with. It's often an area when we're doing audits on clients that we always have to relook at and correct. Okay. Other things to consider if you are in finance, and I've stressed this earlier, is obviously making sure that your accounting records are maintained timeously, they're being prepared regularly, and they're up to date. Then accrual versus cash basis. Now, for most organizations, things are captured off the bank statements, which means it's cash basis, which is fine for during the year. But at year end, from an accounting perspective, cash-based cash accounting is not allowed if you are a company, because you have to comply with recognized accounting standards. And generally, your trusts and your voluntary associations, those ones, you can do cash accounting if your accounting policies is to do cash accounting, right? Accrual basis basically means that at year end, you recognize all income and expenditure related to your financial year. So for example, if you take your utilities expenses, right, you generally only pay the utility for the month in the next month. So at year end, your year end electricity bill may not have been paid. Therefore, you need to raise an accrual. So you record on your financial statements that you owe the municipality X amount for the last month. That is essentially what accrual accounting is. Making sure that your financial records are updated frequently. And the other thing to consider is the efficient use of cloud technology and document storage and data retention, right? Now, some of the tools that we use as a practice, I mean, we're using Xero. We've moved over from Pascal to Xero. We did that last year towards the end of the year. And then with Xero, we're using HubDocs, which is a document retention platform as well. And then we use DraftWorks for our audit and for financial statements, right? So for your organization, you obviously need to make sure that you're using the correct sort of technology, and then the technology that you are using, you're getting the most out of it, you know, that you're not still stuck in doing things like how they were done. I'm not even going to say 10 years ago. I'm just going to say even 5 years ago. You know, things have evolved so much over the last few years that if you are still processing the same way that you were doing or that the person before you was doing 5 years ago, you haven't embraced technology and you haven't moved with the times. So if you want to revisit some of the the technologies that's available, maybe just revisit Riza's webinar from last week, because he went through a lot of the tools that's out there to maximize how you are running your organization and to make sure that you're running things efficiently. Okay, so we're now going to go on to management and donor reporting. If we look at management reporting, essentially, I mean, as management, you need to be making sure that your organization is run properly. Most organizations, when you speak to top management, they don't know what's going on in finance. They've never seen a management report. They only know about, from a project perspective, okay, how they are doing against budget. But when you are managing your organization, you're managing it as a whole, which means that you need to be looking holistically, not just only on a project basis, but on an organizational perspective, on a monthly basis. How are you all doing against budget? I've seen budgets where the budget only talks about program costs, and then you've got all these operational costs like salaries, and you think, okay, but now why haven't you budgeted for your operational costs as well? Because you need to run your organization. So you need a holistic approach to monitoring your performance, which means as management, you should be analyzing on a monthly basis, how is the organization doing as a whole against the budget? That way you can say, okay, we have an issue coming up where we're not going to have sufficient cash. We need to now go aggressively for funding. Okay. You should be looking at your balance sheet on a monthly basis and your reconciliation. So when I say reconciliations, a simple one, like, does my bank balance on my financial records actually reconcile to my bank statement? It sounds so simple, yet there are so many organizations out there where that doesn't reconcile. And nobody knows about it until the auditor comes along 1 year later and they're looking at things and they're asking, but why doesn't it reconcile? Because it's something that should be done on a monthly basis. So from management reporting, these are some of the key things we've looked at. Then if we look at donor reporting, right? So donor reporting, I think all of you sitting here will agree that every donor is different. Their reporting requirements are different. Their templates are different. I mean, we've come across so many different donor reporting templates where we assist clients with completing them. And some of the challenges that you experience is that, one, there's often this lack of awareness and understanding of what the donor reporting requirements are, which was one of the very first challenges I picked up. So you don't know what you need to report on. Your donor reporting format is not consistent with the information that you have available. So, to extract that information is a challenge. Then often you find that there's errors in reporting, which hasn't been picked up because your accounting records are not up to date, or the format, is not consistent with what the donor wants. You then have a delay in completion and submitting of your donor reports, which then means your donor reporting deadlines are not complied with. And that is a huge thing with not complying with donor requirements or donor reporting deadlines, because often that could result in, the donor, reconsidering whether they want to continue providing you with funding. So those are some of the challenges that you have. How do you manage those challenges? Well, from an accounting perspective, you obviously need to be prepared, right? It's like with any deadlines that you have. I'm the type of person that if I know there's a deadline coming up, I have to be done with it at least 2 days beforehand. I hate doing things last minute. That's not my style, but you do get certain people where they will work right up until the deadline is tomorrow. They'll be working on it tonight to get it submitted, right? But that's not how you should be operating from a finance perspective. Deadlines should be met in advance. And how you meet that is obviously by having internal deadlines in place. So if you know, and you can use, project reporting tools such as Asana to basically map out what are all your different reporting requirements. So from a compliance perspective, you have reporting requirements. What is each donor's reporting requirements? And then what information is required? So your processing system should be set up in a way that will allow you to extract the data for the donor report. Now, I'm not saying that your processing records is going to be exact as the donor reporting, because every donor is different, but it should be set out in such a way that you can extract the key information easily from the system. If you are reviewing and preparing reconciliations on a monthly basis, you won't have any challenge with donor reporting, because any queries or any variances that would have arisen, you would have resolved it before you actually have to submit the report. Because more often than not, when you're doing a donor report, besides just submitting the numbers, you've got to also submit to them the analysis of your budget versus actual with explanations. Now, if you're only doing that the day before the report is due, you've got a challenge. But if you have done your analysis as part of your monthly accounting process, you've analyzed budget versus actual, you've got those explanations. When it comes down to doing the donor report, it's actually quite easy to do. And obviously, your documentation must be available, and it comes down to how do you maintain your supporting documents. I've seen some donors where they want every single invoice has to be uploaded to them, right? There are donors that go to that extent where they want every single document. Now, you can't be looking for documents the day before the deadline, right? Your processes need to be put in place so that you are filing or you are scanning all these documents on a monthly basis so that you already have your file ready. And then that way you can be better prepared for donor reporting. If we look at statutory and fund audits, okay, so from a statutory audit perspective, often we get asked, and people use the term audit very loosely. We often get asked, when do we need an audit, or who can do an audit, and what's the difference between an audit and a review and a compilation, and what is PI score, right? So basically, in terms of when you need an audit, for NPOs, I've got up here the requirements for compulsory statutory audit, right? But if we look at it, points 4 and 5 is generally where most nonprofits sit in, and that is where your public interest score, which is your PIS score, is above 350, or if your score is between 100 and 350, your financial statements are internally compiled. That is when you need an audit. How do you calculate your PI score? Well, it's based on the size of your organization. You get 1 point for every million in turnover, which means your funds received, 1 point for every million in third-party liability, 1 point for every member of the company. So NPCs don't have shareholders, so it would be 0 there, and you get 1 point for the average number of employees during the year. Then who can do an audit? Well, if you need to have an audit done, it has to be somebody who's registered with IRBA as a registered auditor. So in our practice, that would be me, Riza and Ridwan are not registered auditors. If what is your score between, if your score is between below 100, then you need an independent review. And then what is an independent review? So an independent review is essentially, it's a smaller version of an audit. So it's not as extensive, so your fee is a lot less. And it's like a trend analysis that they're doing. So they're just doing a high-level review of your organization. They won't go in and inspect certain documentation unless an explanation doesn't make sense, right? So you will need a review if your public interest score is below 100, or it's between 100 and 349, and you prepare your financial statements externally. Sorry, that should say externally. I'll just fix that slide at the end. Who can do a review for you? Basically, any CA can do it. If your score is between 100 and 350, you can get a registered auditor. And if you're below 100, then it can be any chartered accountant, registered auditor, or anybody that is qualified to sign off as an accounting officer, which means that they are affiliated with some accounting professional body. Okay. Statutory audit. So I'm just going to go through this quickly because we're almost running out of our time and we're going to eat into question time. So from a statutory audit perspective, some of the challenges that I've experienced is that generally there's a lack of documentation, available at clients. There's a lack of controls, or if there are controls, there's no real evidence that the control exists, and there's generally an inadequate preparation for audit. So for all our new clients that we take on, we often have this issue where the trial balance is not finalized, so they've done no accruals, they've done no deferred revenue adjustment, and they don't actually understand what is expected of them as the finance team for the audit. For TPC, we've developed an audit checklist. It's quite comprehensive. That is just one screen. And often when I send it to our new clients, I often have to warn them in advance to say it is very long, but it's a comprehensive list of what we think you need to have prepared in order for us to do your audit. So it is quite an extensive list for our clients that we do audits on. We do send these out in advance, obviously, to give you time to prepare. Your fund audits. Okay, so just in a nutshell, what is a fund audit? So your fund audit is required by a funder, right? It's not anything to do with your statutory audit. It relates to a specific program or a project. The type of report that you get is a factual findings report, so you don't get an audit opinion. And your procedures will vary, right? So how do you prepare for a fund audit? The most important thing is obviously to engage with your funder in advance, because you want to know if there's any specific procedures they want covered, any specific, like some of them specify what coverage they want to be tested. Reviewing your grant agreements to see, okay, are there any clauses relating to fund audits? Understand them in advance, and then communicate with your auditor, obviously, on the procedures that need to be done, and then maintaining your documentation and supporting documents. That's how you would prepare for it. Some of the procedures that we would do in a fund audit, I mean, I'm not going to go through all of that, but essentially it's looking at the grant agreement, inspection of documentation to support expenditure that you're claiming. We would look at budget versus actual, tracing to bank statements. So most of these are basic ones, and we do additional procedures depending on what the funder wants. Points that you need to keep in mind if you've got a fund audit is that, one, make sure you have a separate engagement letter for the fund audit, that you actually understand what procedures are being done, that it's in line with the funder's requirements. That's very important, because you don't want to do a whole lot of, you don't want the auditor to go and do a whole lot of procedures, and then it goes to the funder, and the funder comes back and says, but this is not what we want, which means then you're restarting the process, and your auditor is going to want to charge you more for that time that they've spent. So, and then this bullet point, the third one, very important, clarify who is going to be paying for the fund audit and how much they're going to pay. Often your funders do pay for these, and they include it as part of their budget. So make sure you know who's paying for it, and use that as your basis to negotiate your fund audit fee. Okay, I've just put up some of the clients that we serve, some of the bigger ones. I'm not going to go into too much detail on these. You can just maybe look at it. We've got some testimonials from some of our clients on there. Okay, and this is now the last bit that we're going to focus on, and then we're going to go into questions. Basically, as a firm, I have mentioned that we specialize in the NPO sector, and one of the things, or two of the things that we've developed, one is we've developed a risk assessment tool, which I'll show you briefly what it is for NPOs. We obviously have then our outsourced accounting solution called CA Connect. Lisa did touch on it previously. I will touch on it briefly. And then we do your statutory and fund audits. We are accredited for USAID audits as well. And then VAT reviews, doing retrospective VAT recoveries for clients. That is something that Ridwan does as part of his portfolio. And when he is touching on VAT in the upcoming weeks, he will obviously focus on that. So I just want to show you quickly what the NPO risk assessment tool looks like. I'm just going to share that screen. Okay, so essentially our NPO risk assessment. So this is a tool that we created for NPOs, and it basically is a questionnaire that we do, and it focuses on 3 areas. It focuses on organizational governance, financial management, and from a controls perspective. And how it works is that we would send you a questionnaire, and each question basically has predefined answers that you would select from. And the questionnaires, or each question, is then also linked to a calculator to basically generate a risk profile for your organization. And once you've done the questionnaire, we then would review that with all your supporting documentations. We then come out and do an on-site review itself, a walkthrough of your systems to verify the answers that have been given to in the report. And we would then do a detailed report to management. So the end product is that you'll get a risk scoring, basically a report which shows you where your risks are, and it's rated as minor risk, major risk, significant risk, or moderate. And you also get a detailed report basically analyzing what are all the weaknesses we've identified in your organization, what are some of the what are our recommendations, and we would give you this. The timeline in terms of this, I'll come back to the cost factor, but the timeline in terms of this is that it basically is a 10-day process that we would do this over. And from a cost perspective, we charge 35,750 plus an additional 6,000 Rand per site. So if you've got multiple sites, we would obviously have to go out to each site. Yeah, and that is our risk assessment tool